Welcome back, investors. Jake here. In this video, we got to cover the absolute train wreck that was Netflix's quarterly earnings statement yesterday. The top news story pretty much everywhere is exactly this. Netflix's stock plunges 37% on shocking subscriber loss. Upfront, what is happening here? It's the story of a hyper-growth company admitting to its shareholders potentially it can no longer grow. We're going to break down exactly what happened, and I will reveal to you my plan and how much money I lost. I was holding call contracts on Netflix, and I, like many investors, potentially didn't see this coming. Now, the S&P 500 yesterday was actually green, up over, I think, like 1.5%. It's green in the morning as I'm filming this video. And the story of Netflix's earnings report, it had good news. Like, it's still a good company with positive free cash flow, growing revenue, and they beat on earnings per share by 62 cents. You know, as far as their net income, it's very, very positive, very good, excellent gross margins, but it's about valuation. What were investors pricing into the value of the stock going forward in the future based on their acquisition of new customers? And Netflix is saying potentially we're not going to have any more customers than we currently have. Here's the stock chart. There's a red bar down here showing trade volume, so you kind of have to scrunch the graph to see the candle here. And this is incredible, guys. Netflix was at $700 a share back on November 17th. Currently, as I'm filming this, it's $224. It's probably going to go to $200 pretty darn fast. So how big of a drop is this? This is a almost 70% drop from its 52-week high not even 5 months ago. This is absolutely incredible. So let's go ahead and pull up the letter to shareholders that Netflix put out. And this is a bad letter, guys. And here's how they start the earnings report. Our revenue growth has slowed considerably as our results and forecasts below show. Streaming is winning over linear. Obviously, they're beating cable. As we predicted, and Netflix titles are very popular. No one disputes this. However, our relatively high household penetration, when including the large number of households sharing accounts, combined with competition, and I think this is what is getting to Netflix, is creating revenue growth headwinds. So we've got a chart here on page 1 of this press release breaking down exactly what is happening. So look at their revenue growth year over year for 2021. You could see 24% revenue growth year over year, pretty darn good. 19%, okay. 16%, still double digits. Bam, here we go. 9.8% year over year growth. Now, for an S&P 500 company, that's pretty good. But investors have been pricing in double digits closer to the 20% range year over year growth. So it just affects all the multiples of this stock, all of the ratios. Revenue here is $7.8 billion. So yeah, the revenue is growing quarter over quarter. However, when you go down here to global streaming paid memberships, this is in millions, 221 million, and it 0.84, it dropped to 220 million, 0.64. Now there's this caveat, you know, they cut off service to 700,000 Netflix subscribers in Russia. That is potentially an explanation for why they decreased quarter over quarter. Now, yes, year over year, when you compare it to quarter 1 of last year, 207, they're still growing subscribers year over year. And if you want to say, okay, this thing going on in Europe and Russia, this is affecting their subscriber growth. But look at their quarter 2 forecast. They're forecasting that they're going to lose 2 million subscribers. So this 221.84 million, so 221,840,000 paid members, it's going to drop over 2 quarters to 219. Netflix is saying we've peaked. As far as paying customers on our platform, the number of bodies, that we service, it peaked in Q4 of 2021. Potentially, they could continue losing more and more subscribers. And yes, you can blame this conflict in Ukraine for a little bit of it, but I think competition is what is hurting Netflix. And I'll give you guys my backstory that I think contributed to Netflix's tremendous growth and popularity. But for those who didn't know, prior to joining the Air Force, I was an English teacher in South Korea. So I moved there in 2009. I left in 2015. And when I was living abroad in South Korea, everyone pretty much pirated all of their media and TV shows and movies while they were there. And when I moved back to America, I didn't want to illegally pirate. I wanted a legal, affordable service that I could pay for in order to get quality entertainment. So this jealous girlfriend meme, I really enjoy this one where, hey, Netflix, 5, 6, 7 years ago was the sole provider of quality, high content streaming for an affordable price. However, since the pandemic launched, there's so much competition out there. Disney Plus, Prime Video, HBO Max, Paramount Max, Discovery Plus, Apple TV, Hulu, Peacock, and YouTube. YouTube Premium, guys. A lot of YouTubers have upped their production, upped their upload schedule, and if you want to just watch ads, you can watch YouTube for free, or you can pay for YouTube Premium. So I think there's a lot of people around the world who are just sick of this. They've had enough of all of these streaming services. They're not willing to pay $120 a month to see all the TV shows they want to see. So the joke is people are actually going back to pirating here. All right, so let's actually go through a couple more talking points on this press release. Then we'll look at the fundamentals, we'll look at the chart. And on Q1 results and Q2 forecast, they do say, paid net subscribers, they lost 200,000 quarter over quarter. And their guidance, losing 2.5. And they're saying the suspension of our service in Russia and winding down of all Russian paid memberships resulted in 700,000. And I think this war in Ukraine is actually having a bigger impact because when you look at paid memberships across Europe, Middle East, and Africa, they lost 300,000, or they were net positive 400 because of Russia. But it makes sense that people geographically close to this conflict potentially aren't looking to increase their monthly costs by adding another streaming service. Or maybe they're feeling insecure about their own, household income, and they're looking to cut costs, and getting rid of Netflix seems like an easy one when there's a war happening on the continent. So that makes sense that, Europe and the Middle East would be potentially looking to trim their monthly costs. The only part of the world where Netflix gained subscribers substantially was in Asia Pacific. So you can see here, paid net additions, 1,090,000. But when we look at Latin America, they lost 350,000. For Europe, Middle East, and Africa, they lost 300,000. And for United States and Canada, they lost 640,000. Now, for the United States and Canada demographic, this actually was anticipated by Netflix. They raised their prices, I think, back in February or March by like $1 or $2. And they know that if they raise their prices, a couple people, they know the percentage that will cancel their subscription as a result, but the offsetting revenue from an increased price makes up for the loss in subscribers. But I did not see this coming, and I don't think a lot of investors did, that 220 million global subscribers across the entire world is their max. They don't think that they're ever going to get more than that. You could blame competition. You could blame, maybe they don't have enough quality content in foreign languages. If Netflix wants to focus on growing their subscriber count in India or China or wherever, potentially, yeah, they need to up their production budgets in these other languages. But you'll notice that as far as average revenue per membership, it's highest in the United States and Canada, $14.91. It's $11.56 in Europe. It is $8.37 in Latin America, and it's $9.21 in Asia Pacific. What's to say? You know, what's Netflix going to do? They're coming up with lots of solutions, lots of ideas how they can increase their revenue while maintaining their existing customer base. So net, they don't think they're going to add any additional customers, but things they can do to increase their revenue to continue growing the company. One, raise prices. They did this for the United States and Canada. They can offer an advertising lower tier. So maybe for $5 a month, you can get a subscription to Netflix with ads, you know, built into movies and TV shows or whatever. Another thing is they can crack down on password sharing. They did say somewhere in this statement that they estimate amongst their 220 million paying customers, there's an additional 100 million households that are sharing a password and watching Netflix's content and not paying for it. So Netflix is going to start taking additional steps to monetize that 100 million households watching Netflix for free based on sharing a password with someone else's account. They also can get into other forms of entertainment potentially on their platform. They've already made mobile gaming and some other kinds of video games, but they haven't had a hit yet. They also can use their positive free cash flow and net income potentially to just buy other companies, find other companies that are successfully growing and might have some way to successfully integrate with Netflix in order to give their brands a boost. But if they want to start looking for deals, potentially there's a small cap out there with good IP or a good service, and Netflix can find some way to absorb it in order to help them grow. Let's go on macrotrends.net to review their fundamentals. And when we look at their revenue, this is a beautiful company that for the longest time has had consistent year-over-year quarterly revenue growth. And going back to 2014, this was consistently in the 20% range, 24%, 35%. In 2018, it was 40%. However, you can notice here in 2019, 31%, the rate at which they were growing their revenue year over year started to decline. It pulled forward slightly because of the pandemic, and then it started contracting. The most recent 2 quarters, 16%, 16%. Takes a couple days for macro trends to update with the new quarterly numbers, but year over year, they grew only by 9.8%. Single digits. Now, for an S&P 500 company with a market cap greater than $100 billion, 9.8% year-over-year revenue growth is still pretty good, and Netflix can still continue growing their revenue probably for a long time, but it's just about valuation. What are investors willing to price in? We'll look at a couple other metrics here, one being net income, and you can see that Netflix has actually been very good about being positive with their net income. And you can see with their trailing 12 months, they've been doing really well, continuously growing this net income. This is a good stock for a value play if the price can just come down. Shares outstanding, no surprise here, but Netflix doesn't buy back shares. And the amount of dilution they've done isn't too bad. They've gone from 411 million shares in existence to 455 over the last 10 years. It's not too bad. But if Netflix wants to reward their investors, they can start using some of their positive free cash flow to buy back shares. They might want to wait a couple months potentially for the price to go a little bit lower so they can buy back even more shares at a cheaper price, because more than likely I think Netflix is going lower. So here's where we got to go, guys. We got to go to the price ratios. PDE of this company is 30. However, factor in a 37% drop, and I mean, the PDE now might be closer to 20. So from a valuation standpoint, it is getting more attractive, but if you're looking to potentially buy now, I would wait a couple more days at least for the sellers to get exhausted. Price to sales ratio, this is where you gotta, talk about it being a growth story. For a price to sales ratio back in 2018 of 12, this made sense if they're continuing to grow revenue year over year by 40%. Prior to this earnings report, the price to sales ratio was 5.18. So let's factor in now a 35% drop since yesterday. So we can cut off almost a third of this price to sales ratio. That gets the price to sales ratio closer to about 3. Let's go to Netflix's competitor, Disney. What is Disney's current price to sales ratio? And look at this, it's 3.2. So by factoring in, declining revenue growth, they're basically valuing Netflix on a price to sales ratio closer to Netflix's competitor, Disney. Let's look at it's not fair to Disney looking at their revenue growth year over year because all their parks got shut down and Netflix wasn't interrupted. But this stock chart, guys, even if you just ignore the fundamentals, this stock chart is now an absolute nightmare. It's below all the candle. The candle's way down here. It's below all 4 of its major moving averages. The 200-day moving average is at 524. The current share price is at 226. Netflix isn't going to be uptrending again or start to recover from this probably until late 2023, even if things go well for it. If, an ad-based version of their platform comes out, they crack down on platforms, password sharing, they buy other companies potentially. Like, they're going to have to do a lot right just to overcome these horrible technicals, as I think large funds and large traders just aren't going to touch this stock again until it can get back above its 200-day moving average. So it's just going to take time for this to come down, for this to catch up. Go into the charts here. Where did it fall? It's here at 226. So obviously it fell to this previous gap up from January of 2018. So you could argue, I don't think this is going to hold. I think it's going to go lower. So you could argue that this is a line of support, giving the stock support. I think this is going to go sub 200 over the next couple weeks, but I don't know. All right, so when we check in with my Schwab accounts, day change, I'm down 5,200. That's a big kick. And yeah, it's because my Netflix call contracts for January 20th of next year with a strike of 400 have been completely annihilated. And this, if you guys have been following me for a while, you know this happened with me 3 months ago with Facebook. And I'm still holding the Facebook call contracts because they report, I think, next week. But I'm giving up on Netflix. With a strike of 400, I'm saying it's going to be impossible for Netflix. Not impossible, but basically 8 months from now, can Netflix get back to 400 for these contracts to be positive? I don't think so. I don't think it's going to get better, especially with their Q2 forecast that they're going to lose an additional 2 million subscribers. So these contracts are currently worth $410. I paid $5,000. Well, it's just one contract, but it's worth $410. I paid $5,000. I'm just going to sell to close it and take the loss. I don't think there's anything that can be done about this. This is a 91% loss on this position. Call contracts, guys, are no joke. You have to be able to stomach and take these kind of losses. This is there a learning opportunity here? All right, so in reflection, there was this huge drop 3 months ago on their last quarterly earnings statement. And you could argue I shouldn't have got into this while it was below all 4 of its major moving averages. I didn't see it being this bad, but it's bad. Okay, everyone, that's all for this update video. You win some, you lose some. That's how it goes sometimes. If you have any comments or questions or want to say I told you so about this particular trade, let me know down below. I love hearing from you guys. Till the next video, take care.